MarketWatch has these interesting articles from actual people asking personal finance questions to financial advisors, and I came across this one that was really interesting, that this person is making $350,000 a year but has $88,000 in student loans, $170,000 in car loans, $2,000 in credit card debt, and $4,500 per month in a mortgage. And I was reading through this, and this certified financial planner in the article suggests getting with a money coach before working with a financial advisor. Whereas a financial advisor assists with developing investment strategies and long-term financial plans, a money coach, like me, offers a more educational experience and focuses on short-term goals for money management. And he's absolutely right. What I do as a financial coach is to help you pay off all of your debts, increase your savings rate by maximizing your cash flow, and help you create a personalized financial system to deploy your money. And I have personally helped countless individuals and couples with debt. And what you need is a direction to get you out of debt so you can start investing for your financial independence. And I've said this in several of my videos that your income does not equate to your wealth. And there are about 35% of Americans making $250,000 a year or more living paycheck to paycheck. So what I'm going to do in this video is I'm going to pretend to be this person's financial coach and show you guys what I would do as a financial coach in this situation. And I don't use anybody else's style of coaching like Dave Ramsey's baby step program. I use my own FIRE checklist to help people get to where they need to achieve financial solvency. And I'm also not going to cut any of this video so you can see how I coach in this video with all of my fancy spreadsheets. Okay, so the first question I want to address is whether he or she should take out a $200,000 HELOC at 9% to consolidate some debt to lower the monthly payments. And I'm just going to call this person Bob to make things easier. Okay, Bob. And I'm also going to answer the question like what I would do in this situation. And I would not take out a HELOC because a 9% interest rate is actually really high. And you're essentially leveraging your house to take out a $200,000 debt to pay off your other debt. So what you're doing is taking out debt, additional debt, to pay off your other debt. And what happens if you miss payments to your HELOC and end up losing your house? And I've seen it happen. And I'm sure that's not something you want to happen, right? You also need to keep in mind that your HELOC usually comes with variable interest rates, kind of like your credit card interest. What we're experiencing in 2022 are fear and uncertainty. The Federal Reserve is still looking to raise interest rates to calm inflation down. When the Fed raises interest rates, your HELOC rates will rise as well. Your 9% HELOC rate will most likely increase throughout the year depending on how hawkish the Fed wants to be. So not only is your HELOC rate unfavorable, but you're essentially leveraging your house to pay off your debt. And you're just treating the symptom of the real problem, which I will get into in a little bit. But the bottom line is, with the hawkish Fed and high HELOC interest rates, I would not use a HELOC to pay off your debt. And you also mentioned that you're looking to for some investment opportunities, and somebody presented you with some opportunities to buy real estate properties. Let me give you the hard, cold truth, okay? You already mentioned that you're living paycheck to paycheck, so you don't have any room in your budget to save or invest your money right now. What you need to do first is to list all of your debts, your housing expenses, and your bi-weekly income. Like this financial planner said, you're not ready for a financial advisor because you're not ready to invest just yet. You're certainly not ready to invest in any real estate properties until you clean up all of your debt except your mortgage. The good news about your financial problem is that you have a high income making $350,000 a year. So congratulations on that. So what I do, first of all, is to break down your income. Your question didn't say anything about your take-home income. So let me do the math to figure that out. Since you mentioned that you're the breadwinner, cool. I'm going to guess that you're filing your taxes jointly and getting paid bi-weekly. Since you're also contributing to your 401k, I would suggest you lower your contribution, but only down to your employer match. If you get a 50% employer match when you personally contribute 5%, then I would just hold it at 5%, all right? However, since your income is so high, you should be able to maximize your 401k with just a 6% personal contribution rate. Your federal tax withholding is probably around $61,000 with the effective tax rate. That should be at 20%, and the marginal tax rate at 24%. Social Security will be maxed out at $9,114 for the year 2022, and Medicare will be $5,100 with a 1.45% deduction rate. Without knowing your whole financial picture, I'm going to assume that you have an additional 10% deductions of your income in stuff like life insurance, healthcare, medical, dental, and maybe even FSA. I'm not going to include your state income tax because I don't know where you live, but let's just say you make about $8,500 every 2 weeks or $18,000 every month. Now that I have your income figured out, the next thing I do is look at your entire housing expenses. And you already said that you pay $4,500 a month in mortgage payments, which is roughly about 25% of your take-home income. So we'll just leave it there. And we're not going to worry about that right now. You said you have about $88,000 left on your student loans, and they were originally close to $150,000. Let me do some reverse math here to figure out what your monthly payment is. So a typical student is structured to pay off in 10 years. And let's just say you have a 6% interest rate on it with $150,000 to begin with. Your principal and interest payments then will be around $1,665 a month. And I'm going to round that up to $1,700 a month to make things easier. So your student loan repayment is about 9% of your take-home income. For car loans, the next one I'm going to go over is your 2 car loans totaling $170,000 for 2 electric vehicles at a 5% interest rate. So just by using this calculator and not knowing how much your original loan amount was, your car payments are about, $2,700 a month for the next 6 years. And that's about 15% of your monthly take-home income. So this is a lot of cars, even for someone making $350,000 a year. This is a common issue I see with people in the high income bracket, that they're buying very expensive cars with no cash down and making outrageous payments on car loans. Now, I don't know if you made any down payments for sure on the 2 electric vehicles that you purchased, but from my experience, I highly doubt that you did. And here's what you have to do to decide. Are you wanting to keep your cars that you owe $175,000 on, or trade them down to something lower? When I was in $110,000 in consumer debt back in 2014, I had about $42,000 total in car loans, and my income was only about $60,000 a year. So it was an easy decision for me to just sell them because my car loans were about 70% of my annual income, right? Your 2 electric vehicles are about 50% of your annual income. And if you love your cars and you want to drive them until they die, then we can make a plan to pay them off. And I have a 2018 Tesla Model 3, and I plan to drive it until it doesn't recharge anymore. If you got rid of your electric cars and decide to drive used cars for a while until you become financially solvent or stable, you could significantly lower your monthly payment by $2,700 a month, or 15% of your overall budget. And if you want to keep them on your budget, then I would just keep making the minimum payments on the cars while you work on your student loans. And I would recommend using the snowball method, which is to tackle your debt from smallest to largest by balance, regardless of the interest rates. The only time I would recommend using the avalanche method, which is to list your debt from highest to lowest by interest rates, is when you have payday loans, high interest credit cards, or any other debt with variable interest rates. Now, let me pull up my fire checklist and go through your priority. The first step is to calculate your fire number. You can check out this video to calculate your fire number, and I'll put the link in the description below. I just don't want to go over that in this video because then it would take too long. The second step is to open up your emergency fund, but only up to your deductible. You'll need to look at all of your insurance plans, like your car insurance, medical, dental, and property insurance, to figure out how much money you'll need to pay for your deductibles if you ever get into a car accident, a medical procedure, or something breaks in the house. If your total deductibles are $2,000, then you want to put that in a high yield savings account that pays you about 2 to 2.5% in interest every year. I've been using Ally Bank for several years. It's a great bank, and this video is not sponsored by Ally. This is going to be your rainy day fund tucked away in a separate savings account. You're not going to touch this money unless it's for something unexpected and necessary. And I want you to remember these 2 words. Anytime you're tempted to touch the money, you have to ask yourself if this is something unexpected and necessary. And step 3 is to contribute to your employer-sponsored retirement account, but only up to your employer match. And I mentioned this earlier. If your employer gives you a 100% match on a 5% personal contribution, then that 5% should be the maximum you should contribute until you pay off your debt. And if your employer doesn't do any employer match, then you're going to skip this step. And the step number 4 is to pay off your debt, right? I would start with the $2,000 credit card debt first that you mentioned in this article. Never ever carry a balance on your credit card month over month. You're making $350,000 a year. So if you're taking advantage of the credit card points, you need to just pay them off every single month. And if you can't control your spending, then I would recommend using the Dave Ramsey method by just cutting up your credit cards, at least until you reach financial stability. And based on your income, you should be able to pay off your credit cards in just one paycheck. And the next thing you want to work on is your student loan with $88,000 remaining. So instead of making monthly payments, you're going to start making bi-weekly payments to match your payment frequencies. And I'm going to pull up this spreadsheet here. And if you get paid weekly, then you want to change that to weekly payments. If your monthly minimum payment is $1,700 a month, we're going to change that to $1,700 every 2 weeks. Now you can almost pay off $88,000 in 2 years by making $1,700 payments every 2 weeks. Now you can even be more aggressive by paying $2,500 every 2 weeks, and you'll be done in less than 18 months. How fast you want to pay off your loans will depend on how strict you want to make your budget. And if you get rid of your electric vehicles and get used cars instead, you could put that $2,700 a month towards your car loans. So student loans, I'm sorry. So $2,700 times 12 is $32,400. So you could pay off your student loans in less than a year if you didn't have those car payments. But again, it's your decision. If you decide to keep your cars, then your debt repayment plan will take a little bit longer. So let's say you paid off your student loans in a year and a half, and you continue to make minimum payments on your 2 electric cars. Then you should have about $135,000 remaining on the balance. Let me double check that, and let me add a 5% interest rate here. Now you can add that $1,700 from the student loans that you no longer pay on, and add it to the student loan payments. If you can say put half of your paycheck towards the car payments at $4,000 every 2 weeks, you can pay off both of your cars in 14 months. And $3,500, let's give that a shot, every 2 weeks will take you a year and a half. And $5,000, if you want to be more aggressive, every 2 weeks will take you about a year. And once you're completely debt free, I want you to go out and celebrate and splurge on something that you couldn't splurge on while you were on your debt free journey. And because you have got past stage 1, which is financial dependency or dependence, and now you're working on financial solvency. The next step is to max out your emergency fund. And that's the same high yield savings account where you put $2,000 away in step 2 of this checklist for deductibles. So if you're the only one making the income, you want to save at least 6 months of your expenses into the emergency fund. If you spend $5,000 a month, just tuck away $30,000. The purpose of your emergency fund is to make sure you don't go back to step 4 to get yourself back into debt again. And once you become financially solvent, then you can move on to maxing out your IRA, HSA, or 401k and start saving money for your investment properties. And just imagine saving $5,000 every paycheck into investments. That's $60,000 a year. And let me pull up the compound interest calculator here. With a 10% average annual return, you're going to be a millionaire in 10 years. And you're going to have $3.8 million in 20 years with the same rate of return. And ever since I started my FIRE journey in 2016, my net worth has increased literally from $0 to $1.1 million. You can also download all of my financial independence resources for free, including all of these spreadsheets, by visiting firesuccess.com/contact. And if you're watching this and you need help with your personal finances, you can also schedule a free 20-minute financial coaching session by visiting firesuccess.com/coaching. I have created several personalized budget systems to help people get out of debt, and I was once $110,000 in consumer debt back in 2014, and I managed to pay it all off in 2 years. And let me tell you, the feeling of paying off my debt was like taking a big weight off of my shoulders. And if you made it all the way until the end of this video, I am still giving away 20% off for my paid financial coaching session. And the coupon code Geronimo will expire on October 31st. So make sure to contact me at hello@firesidechat.com or DM me on Instagram. If you want to know more about how to start saving for your financial freedom, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.